The seal is still intact. The classification has not changed. The weight behind it has been quietly removed. Inside these offices, a number was assigned. That number traveled further than anyone who assigned it. A classification is not a fact. It is a decision. Some decisions outlive the reasoning behind them. Capital moves toward confidence. Confidence, in this era, was something that could be issued on a schedule. The instruments were assembled in layers. Each layer carried the weight of the one beneath it. None were inspected after assembly. Risk analysts worked in separate corridors. Their conclusions did not travel to the floor where ratings were finalized. The obligation to assess had been replaced by the obligation to deliver. The difference was institutional. It was also enormous. Pension administrators received the classification. They acted accordingly. They were not wrong to trust it. The model that produced the rating had assumptions inside it. Those assumptions had not been reviewed in several years. Revenue came from the issuers. The issuers needed favorable outcomes. The process continued to produce them. Structured products multiplied. Each one required a classification. Each classification required less time than the one before it. An analyst flagged the correlation assumptions. The flag was noted. The rating was not revised. The institutional memory of a rating agency is held in precedent. Precedent resists revision. That is its function. Somewhere in the chain, the underlying asset value began to separate from the classification assigned to it. The gap was not reported outward. The classification remained. Both facts coexisted without resolution. Institutional investors allocated billions based on the classification. The allocation moved quietly through clearinghouses. No alarm was triggered. A rating carries legal weight in certain jurisdictions. Mandated holdings require it. The classification was doing work it was never designed to do. Internally, the deterioration was visible. The internal record and the external classification had become two separate truths. The issuer returned the following quarter. The rating committee convened. The outcome was the same as the quarter before. Competition between agencies was a structural condition. An agency that downgraded lost the next mandate. This was understood and unspoken. Some methodologies were copied between agencies. The shared assumption moved through the system without independent verification. The floor set by regulation became the ceiling of internal ambition. No agency exceeded it. None needed to. Retirement funds in 14 states held instruments rated as safe. The funds had no mechanism to verify the rating independently. The regulator referenced the external rating in its own oversight framework. The rating had entered the regulatory infrastructure. It was load-bearing. New issuances continued to arrive. Each required classification. The queue grew without a corresponding expansion of scrutiny. Scrutiny takes time. Time was the one resource the system had decided not to allocate. The classifications continued on schedule. The analysts who produced the internal assessments were not present in the final meeting. Their conclusions arrived without their voices. Across the Atlantic, European institutions held the same instruments. The classification had traveled with the product. So had its inaccuracy. The classification system had become a condition of participation. Without it, the market would not accept the instrument. This was known. The housing market was softening. The instruments built on it were not softening in their classifications. The distance between them was growing. Default rates in the underlying pools were rising. The data was available. The schedule for review had not been accelerated. There were persons inside those agencies who knew. Knowing without authority is a condition that institutions produce reliably. Those who study these systems over time observe a recurring condition. Delay is not an accident. It is the default output of a conflicted process. By mid-2007, the volume of instruments requiring review had exceeded any realistic capacity. The classification schedule did not reflect this. The first major downgrade, when it came, was not a revelation. It was a formality. The internal record had reached the same conclusion months earlier. The downgrade was issued. The market moved. The persons who had held the instrument on the basis of its previous classification had no recourse. Across the market, sequential downgrades began. Each one triggered further forced selling. The mechanism had been set in place years before. Institutional investors could not hold instruments below a certain classification threshold. The threshold had just moved. They were now out of compliance. Forced selling into a declining market suppressed prices further. The price suppression triggered additional threshold breaches. The loop had no natural exit. The agencies did not cause the crisis alone. They held the door open. Others walked through it for years. Congressional hearings were convened. Agency representatives were present. The methodology that produced the ratings had not yet been formally revised. The hearings produced testimony. The testimony produced recommendations. The recommendations joined a queue of unimplemented revisions. Reform legislation was drafted. Its language referenced the rating agencies by function. By the time it passed, the agencies had already adapted. The three dominant agencies retained their market position after the crisis. Concentration had not decreased. The field had not been opened. The issuer pays model was reviewed. It was not replaced. The structural condition that had produced the conflict remained structurally intact. Pension beneficiaries in 14 states absorbed losses that had already been calculated internally before they were announced publicly. The gap between internal assessment and public classification is not unique to this period. It appears wherever the incentive to delay exceeds the incentive to disclose. Dodd-Frank introduced oversight of the agencies. The oversight was assigned to an office within the existing regulatory structure. The structure had not changed. New structured products entered the market after 2010. They required classification. The same three agencies classified them. The methodology was updated in documents. The incentive structure that shaped its application was not updated in practice. The system did not fail because no one understood it. It continued because understanding it was not sufficient to interrupt it. Classification is a form of institutional speech. When that speech is compromised, the compromise spreads without announcement through every system that accepted it. The floor did not hold. It had never been load-bearing. It had only been described as such for long enough that the description became the structure. The agencies are still in operation. The instruments are still being rated. The floor is still being described. The seal remains intact. The classification has not changed. What lies beneath it has already been decided.